Welcome to the Purpose Focused Advisor. This show is for financial advisors who want to grow their business with clarity, lead with purpose, and build a life that reflects what matters most.
Welcome back to the Purpose Focused Advisor. Rob Brown here today with my guest, Vincent Randazzo. Vincent is the founder of ViewRight Advisors, where he equips financial advisors with a disciplined, objective risk management process to navigate market cycles with confidence. That's a big statement, Vincent.
It's bold.
Vincent is a chartered market technician. He's been one since 2008. He has developed proprietary market breadth indicators that help identify major market turning points several different times in 18, 20, and 22. And before he started ViewRight, he was the head of technical research at CFRA and Lowry Research, the nation's oldest technical advisory firm, where he collaborated with industry leaders like Sam Stovall, one of my favorites, and Paul Desmond. With more than 2 decades of institutional experience, Vincent integrates data-driven insights with purpose-focused mindset to help advisors protect and grow client wealth. And as you might guess, Vincent, in that introduction, my favorite words were purpose-focused, because there is purpose behind what you're doing at ViewRight. So tell us about that. Why ViewRight and why now?
Absolutely. Well, first, thanks, Rob. Thanks for having me. I really do appreciate it. And I think this is going to be a conversation for the very reason, we just talked about it. There's a reason behind it. There's a focus here. And it was driven by, my observations over almost 25 years and working with portfolio managers and advisors in sort of a research or research sales capacity most of the time. But through that career, I saw that a lot of the advisors that I spoke with had a lot of the same challenges. There was just too much noise, too little time, and really a lack of a consistent risk management process. And then add on top of that, you've got the rise of ETFs and easy access to information. And a lot of the clients of these advisors, especially the younger ones who are going to be inheriting the wealth, they sort of start to question paying for what seems like a generic, buy and hold strategy. And that's really why I created, the system and the service, is to help advisors to sort of solve for these bigger picture issues in a way that I know how, which is through risk management.
Well, Vincent, come on. Isn't that like old school? We don't really need to do that anymore, because markets just go up. And if they do go down, it's only for a month or so.
Yeah, I know. I think it's such a common. I know you're saying it, tongue in cheek, but it's sort of a common way of thinking about things. 16 years into really a cycle that's been that way, right? What history tells us, though, is that those times do not last forever. Yeah, they last for years and even decades, but not forever. And they're punctuated by periods of sort of the opposite, where you have bear markets or sideways markets, where you can go 10, 15 years without making major new highs in the indexes. So my system is sort of preparing advisors, or providing them an insurance policy that's adaptive, right? That addresses that eventuality, which is that there's going to be another decade like that. It's going to come, and it's going to really hurt a lot of people unless you're ready to take it on.
So in the work that you've done so far, as you've been interacting with advisors, what's the first thing that they ask or maybe push on when you suggest that maybe they need to add another tool to their toolbox, which will allow them to be better at what they do by putting in a more disciplined layer to their approach to minimizing or managing risk?
Yeah, I think a lot of it sort of stems from what you just said, which is that, hey, things are going just fine the way we've got them. And and then I kind of step back a little bit and I just kind of think about it. And we talk through it. I say, listen, advisors are fiduciaries. Really at the end of the day, they're stewards of their clients' wealth. And with that comes a responsibility that goes beyond just riding the market. And I think clients expect more, and rightly so. And I think that's becoming increasingly the case, where the value comes in how we manage risk, how we protect their wealth, right? And then make disciplined decisions that serve those clients' best interests. And I've heard you say this before in one of your other interviews, and it really resonated with me. You said the meaningful leads to the measurable, right? And I really like that. And in this case, the meaningful is sort of honoring that fiduciary duty and building client trust, right? And the measurable is how effectively we limit drawdowns and are able to protect that wealth and provide a smoother path of compounding for clients.
So drawdowns, that's a dirty word, and I say this a little tongue in cheek. And I apologize if I'm overdoing it, but I've been at this a long time. I started, in the investment business back in the mid 1980s, and so I've seen some ups and downs, and I've managed client portfolios through them, sometimes better than others. It's actually one of the reasons that I no longer hold myself out as an advisor, because that work is hard if you're doing it right. But I also know that the times that my team and I were doing the best job were when we decided to layer in some technical analysis. We used point and figure charting to look at everything that we did so that we could really not time the market, but have some understanding of what sectors to be in or to underweight in, or when something might be getting a little long in the tooth. And I hear that same thing is what you're trying to help advisors understand. What's the receptivity like?
I think it's not as warm and fuzzy as you would hope it to be, but I think it's about positioning. So for me, I focus on the fact that we're not talking about price, because they sort of say anybody can draw lines on a chart, or anybody can look at moving averages and things like that, which is totally true. So my analysis really takes a very deep level look at the market internally. And we're focused on things like how many stocks are going up versus how many stocks are going down. So simple advanced decline statistics over time with thresholds and rate of duration and things like that. On top of it, new highs, new lows, percentage of stocks above their longer term moving averages. Items like this that tell you what's the true health of the patient, because the market cap, the major indexes are market cap weighted. So especially now, you get this huge skew of the biggest, healthiest, strongest companies. And this isn't like unique to this time frame. You've seen this over the last 120 years where the biggest and strongest companies keep getting rewarded with more and more capital. The only issue with that is that toward the end of a cycle, those are sort of the only ones receiving capital. And everything else has sort of fallen to the wayside, which creates what we call divergences, where you have the majority of stocks are actually going down under the surface, but on the surface, when you look at the price indexes, everything is just continuing to make new highs. So you have this sort of mirage, right, where everything looks great, but under the surface is actually quite a dangerous situation. So what we're aiming to do is identify those conditions that lead to high probabilities of major drawdowns. So it really is a differentiating factor for us because nobody else does it the way that we do. And certainly just hammering that point home that you really can't fool market breadth. It sort of is whatever it is, and it can't be changed. It can't be interpreted in any different way. It's too simple to be interpreted a different way. Whereas if you look at a chart pattern, some analysts would look at it and say, oh, that's a Head and Shoulders, and some analysts will say, oh, that's this or whatever, and they'll have different implications based on that. So the fact that we're looking at what is, I think, pretty immutable in some of these numbers and statistics, I think is a real advantage for us.
As you say this, I'm thinking to myself, gosh, wouldn't it have been easier to stick with institutional investors and share your research and your analysis, which I know you did, for years through your in your prior life. Why step into? I know a lot of advisors don't like this word, but into retail, into the private client space, because there's, I think, in general, and maybe this is an overgeneralization, but maybe among advisors who have never looked at this before, and certainly among their clients, it's like, I didn't hear about this before. Why is this important now? So why did you kind of cross that bridge from the dark side, the institutional side, to the side of light and taking care of individual clients?
It's a great question, and I think one that I don't take this lightly. Like I said earlier, I feel like it's a responsibility to help advisors if I can help them, and I've worked so closely with them through my whole career. I feel like there's sort of a kinship there, because I also have spoken to their clients, and I feel like this is where the biggest need is. Right, institutions have access to all sorts of fancy tools to help them manage risk, and financial advisors, by and large, just don't. And to me, I want to just democratize access to something like this, which is really an institutional grade, to your point, an institutional grade solution, but pointed at the people who need it most, honestly. And that, to me, is what drives this whole venture, is that getting the help to the people who need it most, really.
When I asked in my pre-show questionnaire, what would you like to share with our audience? I loved your answer. I'd like to share how we're helping advisors bridge the gap between client expectations and market reality, and that and that's a big part of what you're trying to do. And as someone who wrote the book, or a book, I was going to say the book on client experience. It was just called Delivering the Ultimate Client Experience. So a book on client experience. How do you, I think you've touched on that a little bit, but I see this as a way to elevate client experience, because you're able to add value at a time when a lot of advisors are thinking, there's going to be fee compression, we should be charging less. Because everybody can do what we do, when in truth, when you add the layer to a practice that's managing money that you're able to do through ViewRight, you're adding value, and you're adding to that client experience, and you're creating a reason for a prospect to become a client, and a client to stay a client.
Yeah, so well said. That's the answer. The answer is not charging less for your services because they're like everyone else. The answer is adding more value where your clients expect it. And I think, like I said earlier, about that expectation, those expectations that clients have well beyond a buy and hold strategy. Well, if you speak to your average client, and I've done enough research to sort of give you these answers, more than half of them, as a primary expectation of their advisor, is to avoid those big drawdowns. And sometimes it's unspoken to the advisor, but a lot of times it's really apparent, and it when you have those clients, because they're going to be calling you out on it. And the last thing you want to do is be behind the eight ball and digging out of holes that you don't need to necessarily dig out of. So I think, again, like I said, with all the technology people have access to, all the information we have access to, we need to be better. We should be better than buy and hold. And clients are smart enough to know that.
Yeah, but I also think there's this misperception that because we have all of these tools, because you can pull so many tools up on your screen to do analysis that the why another one, why a new one, and I guess without having this come out the wrong way, what you're doing isn't new. It's the application of what you're doing that really is new. Um, but it's in the application. It's making it something that is repeatable and built in that is so important. It's not just I have the tool so I could do that. It's
Mm-hmm.
I'm using this tool because this helps me add this kind of alpha to my portfolios that I know when I'm having conversations with my clients who are worried about the next drawdown, that there's this repeatable process that's built in. It's not just saying, hey, I'll know the right time to get out of the door, and the next thing you know, everybody's heading for the same door, and only a few people can squeeze through.
Yeah, it's a great point about process and system, and it's another primary point. I'm very systems oriented. I like to have that. To me, it's a way to be prepared, and it's a way to be confident. That was one of the things. I'm an Eagle Scout, and be prepared. That's the primary motto there. And when you're prepared, you have great confidence, and people feel that. And you certainly want your advisor, if you're going down a path when it comes to the stock market, which is really uncertain at times. Nothing is guaranteed. You want someone who is confident, has a process that they can rely on, so that you can rely on them.
Yeah, no, absolutely. And I just wonder why that can be hard to drive home with advisors sometimes who see the importance of process and discipline, but maybe do lack confidence in what they're doing. I talk with advisors all the time that, it's they're shifting back and forth between, should I outsource my, money management, or should I do it internally? And maybe even they change over time. And it's because they have a lack of confidence in their process. But if they take the core of what they do, that is, the core of what they do, that is doing the right things for their client, and layer on things that make that better, their processes are going to be better. We talked about client experience, the portfolio performance, the emotions of clients are going to be all impacted by that.
Yeah, I mean, I think it's one of those things where you want to have insurance before the house burns down, not after, right? And ideally, insurance isn't going to be that much of a drag for you. It's not going to cost you very much, but if something happens, it really pays off.
Right.
And that's the idea of what we're providing here with for folks. And one of the reasons for that, and I think going back to what you said earlier about how do you hammer this point home to advisors, something that really seems to resonate is how drawdowns affect your long-term results, because it's not something that people talk too much about right now, because the market has been so smooth to the upside. But I'll just say the phrase, sequence of return risk, right? It's just that the order matters when you're talking about returns, especially for those who are in retirement or really close to retirement, especially as we're headed toward the end, let's just say, of a secular bull market, most likely into a period of time that is likely to be a lot more difficult. And I use this simple mathematical equation. I just say, okay, imagine you have 3 years. The textbooks say 9% a year. That's what you get. Okay, my first example is 999. Okay, obviously that averages to 9%. My second set of numbers, minus 30, 27, 30. Also, it averages to 9 per year. But if you think about from point A, year one, to the end of that last year, that first set of numbers, that 999, that gets you about a 29% return, total return. Now, in the more volatile sequence that I mentioned second, you only get about a 15% return. So imagine how that changes the numbers over 30 or 40 years of real life returns when you have a decade that could be smattered with a lot of those negatives. So I think it's something that's being really heavily underestimated right now, and it's something that honestly a lot of advisors don't really talk about. But when I mention it to them, they like remember it from their CFP studying days or whatever, and then we get a little bit more of a detailed or in-depth conversation going, which is really fruitful.
Yeah, and again, for somebody who's been around the industry a long time, as I have, um, unfortunately, the attention that is paid to the concept of sequence of returns seems to be stronger after the market sells off
Yeah.
and not before. And of course, I know you're not trying to predict, the end of the secular bull market. In fact, you're probably happy if it goes up forever, and you're wrong. Um, but it probably won't. And understanding that sequence of returns and how that truly impacts people's livelihood in retirement, because the order of those returns matters.
Yeah. Yeah. I mean, you think about like, okay, a 30% return, 30% drawdown. Well, 30% drawdown takes almost 45% gain to recover from. A lot of people don't, think about it like that, but that's how the math works. You can't fight it.
Yeah, sometimes the simple math is the math that upsets you the most, because you want to be able to make it go away, but it's not going to go away. And I think that also goes back to this purpose that you have behind what you're doing is, um, you know putting aside the specific work that you're able to do through ViewRight as you help advisors. It's a real mission to go out there and keep as many people as possible from making mistakes, because um, the mistakes that can get made can have lasting financial and beyond impacts on people, because they could have paid attention to something, or more rightly said, their advisor could have been paying attention
Hmm.
to something that they maybe aren't paying attention to now.
Yeah, I don't have as much experience in the market as you do. I mean, I started my career in 2020, 2002, and 2002, and so a little over 20 years ago. Of course, toward the tail end of a major bear market and the start of a secular bear market, because we didn't make new highs that took out those 2000 highs until 2013, right? So I remember a lot of stories, and I knew a lot of people. I knew a lot of advisors who had to work another 10 or 15 years to climb out of some of those holes, whether it was the 2000 bubble wreck hole or whether it was the great financial crisis hole. I mean, I remember those stories. It really, really affected me in my formative years of my career, and that again is another reason why this is so important to me, and why I think we just need to do more education around this topic and make sure, like I said, we're just prepared. We can help people.
And that's the great thing. One of the great things about what you're doing. Obviously, you want to get more people, more advisors working with you, so you can help them help their clients. But even if not, you don't convert 100% of your opportunities. You are educating the marketplace advisors on what
Hmm.
is going on, and something that maybe not enough people are banging the drum about right now.
Yeah, education is definitely part of the process, and I think you've got situations where you leave enough of an impression, and they remember, and they say, "Okay, the house is on fire now. Who am I going to call? There was something I think that can help me with this before this house burns down." I think that's something that, again, human nature, right? The necessity is sort of the mother of invention or reaction, but uh, again, I think it is the duty of the advisor to be better than that.
Yeah.
To take that really, their role very serious, and I think this is part of that, right?
Yeah, yeah. Well, I would agree. So it's about time to land the plane. What haven't we talked about that you would like to share to make sure that the audience learns about. And then when we're kind of done with that, I'll give you a chance to let people know the best way to connect with you.
Sure. I think the market being as competitive as it is for advisors out there, I think this is just another way to differentiate themselves in a really crowded marketplace where they are short on time, where their clients are demanding, and with something that we all need is that protection. So having this as a sort of competitive edge for you that you can sort of bring in, I think that's really powerful. And I've seen it in the folks that I've worked with so far. They've told me as much that, hey, this is a competitive advantage for us now. We can have these conversations proactively and sort of bring this to their attention as a potential hole that maybe their peer who's trying to win that account as well is not talking to them about.
Yeah. And this will maybe sound a little funny, but in this world where advisors are thinking, how can I add more value? How can I add more value to the client experience? And I know your solution doesn't apply to every advisor, but to those for whom it does apply, isn't working using a tool like this much more of a value add than deciding whether you're going to send birthday cards through the mail or electronically or not? I mean, and I those things can be good things for client experience, but there's a difference, and I say that more to present kind of stark contrast, because there's a tendency for advisors when thinking about adding value to add fluff when you can add meat to the equation that really makes what you do stronger.
Mm-hmm.
And not just to say that you do it, but to actually add something to that client equation that will put your clients in a better position longer term.
Yeah, I love that. I love that you think that way, and that you said that and you brought that up. I think it's about creating raving fans, right? I mean, we all know those are your best clients, right? Those clients that are going to advocate for you. They're going to bring in new clients in the door. Listen, if you save people, I guarantee, right? If you save people from a 30% or 40% drawdown, they're going to be a client for life, and they're going to bring all sorts of people to talk to you, because I think more and more that's going to be a unique skill set, being able to do that, like I said, with a system that is repeatable, not just a one time thing. So that's how I would sort of address that and just say, hey, listen, this is really something that will set you apart, like I said, and convert loyalty, just through this process, and having a transparent conversation even about risk and managing risk. You can really position yourself as a as a real expert in this field, even if you don't necessarily have all the tools yourself or have all that knowledge yourself. You're leaning on a system that's able to give you that in a simple package.
Yeah. Well, I think that's a great place to end. Before you tell us, Vincent, what's the best way for our audience to connect with you and to learn more about what you're doing at ViewRight?
Yeah, so I would say best way to get some information on what we do and actually reach out and contact us is through the website, which is ViewRight.AI. So no .coms, just ViewRight.AI.
All right. Well, we'll be sure to put that in the show notes. And I know that we also connected through LinkedIn, so I think you hang out there too.
I do. I'm on LinkedIn. You can find me, Vincent Randazzo, CMT, and then I'm on X as well. So whatever medium of works for you, I'm there.
Okay. Just wanted to make sure that it's somebody wants to connect in a different way, that we give them a couple of options. Well, Vincent, it has been great to have you on the show. I love what you're doing. I feel like you're a fresh voice in a world that really needs this voice right now, because whether you adapt ViewRight or not, this is a discussion you need to have with your team, or consideration you need to have when you think about what you're doing for your clients. And it may not fit,
Sure.
but you better have the conversation, because this is the right side of that secular bull market to do it.
Yeah.
Go ahead.
I was going to say thank you for saying that. I really do appreciate that, and it's well said.
Yeah, awesome. Well, to our audience, as always, thank you for listening, and remember, we are rooting for your success. Take care.
Thank you. Thanks, Rob.
Thanks for listening to The Purpose Focused Advisor. If today's episode gave you something to think about, or a step you're ready to take, head over to truestfancoaching.com. There you'll find tools, resources, and ways we can work together to help you lead with purpose and build the business and life you were meant for. If you enjoyed the show, we'd be grateful if you take a moment to rate and review it. It helps more advisors find their way here.